A business magnate once said, "The stock market is a device for transferring money from the impatient to the patient." That man is Warren Buffett. So today, we're talking about the top 10 best dividend stocks that are worth your patience the most. In this video, we will be talking about the which ones and the whys of these stocks that are guaranteed to make you rich in the long run. Let's dive right in. Number 1, MSCI. Let's kick off our list with MSCI Incorporation, a financial services company that specializes in index and benchmarking services. Over the past 3 years, MSCI has impressively grown its dividends by an average of 26.6% annually, showcasing its commitment to rewarding shareholders. While the current dividend yield stands at 1%, MSCI's strong projected earnings growth over the next 5 years and forecasted EPS growth of 14.3% for the coming year signal potential for continued dividend growth. What's more, MSCI's dedication to enhancing shareholder value is evident through its buyback yield of 1.7%, demonstrating a well-rounded approach to boosting returns. With a reasonable dividend payout ratio of 45.9%, MSCI seems poised to sustain its dividend growth journey. Number 2, ITT. Next up, let's dive into ITT, a company that manufactures components for diverse industries including automotive, aerospace, mining, and oil and gas. Impressively, ITT has consistently increased its dividend by an impressive average of nearly 20% annually over the last 3 years, with analysts projecting a robust 13.3% earnings growth in the coming year, and an anticipated 10.6% annual EPS growth over the next 5 years. ITT appears well positioned for sustained expansion. Notably, ITT boasts a modest dividend payout ratio of just 22.9%, signaling ample room for continued robust dividend growth. The company's commitment to enhancing value is further exemplified by its 1.7% buyback yield. With these factors in mind, ITT stands out as a compelling contender for dividend-focused investors. Number 3, ORCL. Let's delve into ORCL Corporation, a prominent player in the tech sector. Renowned for offering cutting-edge database solutions and software to global enterprises, ORCL's impact is far-reaching. ORCL has impressively achieved an average annual dividend growth rate of 18.6% over the past 3 years. Presently, it boasts a dividend yield of 1.4%, indicating a commitment to shareholder value. Looking forward, analysts anticipate a robust 12.7% EPS growth in the coming year, accompanied by an 11.5% average growth over the subsequent 5 years. With a moderate payout ratio of 43.2%, ORCL holds the potential to sustain its dividend progression. A buyback yield of 0.6% further underscores their shareholder-focused approach. As technology continues to evolve, ORCL's dividend potential remains captivating, showing us that glimmer of hope in achieving financial success. And isn't that the main reason you're here after all? You're in pursuit of your goal, which is business success, driven by dedication and motivation to make everything work. Well, not to worry, because here on Business Mind, we want you to dream big and achieve bigger. And we've set it up just for you. Check the link in the description below, and who knows, your streak of success might just be one click away. Number 4, PH. Moving on, let's explore Parker-Hannifin Corporation, an industrial conglomerate that produces a diverse array of components for various industries. PH has consistently elevated its dividend by nearly 19% on an annual basis over the past 3 years. At present, it maintains a reasonable payout ratio of 45.4%. Looking ahead, analysts predict a 6.5% earnings growth in the upcoming year, and an attractive 11% annual EPS growth over the next 5 years. With this projected earnings growth and a manageable payout ratio, PH seems poised to further enhance its dividend distribution. As investors seek sustainable returns, Parker-Hannifin Corporation presents an intriguing proposition within the realm of dividend stocks. Number 5, Elevance. Now let's shine an uplight on Elevance Health, a notable presence in the health insurance sector. As one of the largest health insurers in the US that stands out for its comprehensive healthcare plans, ELV has achieved an impressive trailing the 3-year average annual dividend growth rate of 15.9%, complemented by a current dividend yield of 1.3%. Looking ahead, earnings growth is projected to reach 12.5% in the upcoming year, followed by an average yearly growth of 12.7% over the subsequent 5 years. With a remarkably low payout ratio of 20.4%, Elevance Health possesses ample flexibility to sustain its dividend expansion. As a pivotal player in the healthcare realm, Elevance Health presents an enticing opportunity for dividend-focused investors. Number 6. DPZ. Let's turn our attention to Domino's Pizza, a powerhouse in the pizza industry. As the largest pizza chain in the US, Domino's commands a significant presence with projections indicating continued growth over the next 5 years. DPZ has demonstrated commendable dividend growth, boasting a trailing 3-year average annual growth of 15.8%, while maintaining a dividend yield of 1.2%. Anticipating robust expansion, analysts foresee a promising 14.5% earnings growth in the upcoming year. The company's payout ratio stands at a modest 34.6%, a factor that aligns well with its growing earnings trajectory. With this favorable combination of factors, Domino's Pizza has ample potential to further elevate its dividend distribution, offering investors a tasty slice of long-term value. Number 7. MMC. Now let's focus on Marsh & McLennan, a versatile company offering a spectrum of services including insurance brokerage, risk and reinsurance, human resource consulting, and management consulting across various industries. MMC has demonstrated steady dividend growth, achieving a trailing 3-year average annual growth of 15.2%, while currently offering a dividend yield of 1.5%. What sets MMC apart is its substantial dividend yield, one of the highest on this list. Maintaining a robust dividend payout ratio of 35.5%, the company is poised to continue augmenting dividends in the years ahead. Furthermore, analysts foresee a promising 10.6% EPS growth in the upcoming year. The company's proactive approach is highlighted by a buyback yield of 1.3%. Number 8. BAH. Now let's explore Booz Allen Hamilton, a distinguished consulting company catering to clients like the US government and major corporations. BAH has showcased consistent dividend growth with a trailing 3-year average annual growth rate of 14.9%, coupled with a dividend yield of 1.5%. Underpinned by these promising numbers, analysts anticipate an 11.8% EPS growth in the upcoming year, complemented by an average yearly growth of 10.2% over the next 5 years. This growth trajectory supports the company's ability to maintain its dividend escalation, a trend established since 2016. Despite boasting the highest payout ratio on this list at 81.1%, BAH retains some capacity for further dividend expansion beyond earnings growth, albeit limited. The company's robust buyback yield of 1.6% offers additional strategic flexibility, affording the potential for alternative allocation of funds. Number 9. UNH. Let's take a closer look at United Health Group, a prominent player in the U.S. health insurance landscape. Renowned for offering a spectrum of health plans, UNH coverage spans an impressive 152 million individuals. UNH has maintained steady dividend growth, achieving a trailing 3-year average annual growth rate of 14.6%, coupled with a dividend yield of 1.4%. Looking ahead, analysts predict a robust 12.3% earnings growth in the upcoming year, accompanied by enticing average yearly EPS growth of 12.8% over the next 5 years. These projections serve as a solid foundation for near 15% dividend increases annually. With a buyback yield of 1.2% and a notably low payout ratio of 29.8%, United Health Group possesses the flexibility to potentially amplify its dividend payouts even further. Number 10. PAYX. Finally, last but certainly not the least, let's delve into PAYX, a key player offering crucial payroll and human capital management services tailored to small and mid-sized businesses. With a reach extending to issuing checks to 1 in every 12 private sector employees in the US, PAYX boasts over 730,000 clients spanning in the US and Europe. Despite projecting the lowest dividend and earnings growth estimate on this list, PAYX sets itself apart with the highest dividend yield at 2.7%. This is coupled with a commendable trailing 3-year average annual dividend growth rate of 12.8%. anticipating a 6.4% earnings growth in the coming year and an average yearly EPS growth of 8.9% over the subsequent 5 years. PAYX remains a robust contender in the dividend arena. With a payout ratio of 75.5%, the company maintains space for more accelerated dividend growth than earnings growth. And there you have it, business minds. We have just unveiled the top 10 best dividend stocks to consider for your 2023 investment strategy. Remember, our channel Business Mind is your compass to financial success. If you found these insights valuable and want to stay ahead in the world of investments, don't forget to hit that like button and subscribe to our channel. As we navigate the dynamic landscape of finance together, always keep in mind, dream big and achieve bigger. With the right knowledge and strategies, your financial goals are well within reach. Thank you for joining us on this journey, and we will see you in the next video. Business Mind, signing off.